Hi, this is Chris Husky. Today we're discussing the Sale-Leaseback, an option for your medical real estate. If you've been the owner of commercial real estate or have otherwise been involved in commercial real estate transactions for a few years, chances are that you're familiar with the Sale-Leaseback transaction. Many people have a general understanding of the concept of a sale-leaseback due in large part to the name itself, which basically describes the transaction. A sale-leaseback occurs when a real estate asset is sold to a buyer who then leases the property back to the seller via a long-term lease agreement. Many sale-leaseback leases are written with longer terms of 10 to 15 years and in some cases over 20 years in duration. The sale-leaseback is a desirable option for many commercial real estate sellers, including medical office building sellers, in that it provides several potential benefits to the seller, including the sale of the real estate generates cash for the seller, who can then pay down debt, improve the balance sheet of the organization, and if structured correctly may also be able to deduct all of the future rent payments instead of being limited to the interest portion of payments that would otherwise be paid to service the mortgage loan on the property. Because the sale-leaseback traditionally creates a long-term triple net lease, the seller may still retain almost complete operational control over the property, including the ability to make improvements to the property. In addition to converting the equity of their property into cash, the seller may be able to receive after capital gains taxes up to 100% of the value of the real estate, compared to a traditional mortgage financing structure which usually only provides up to 60 to 80% of the property's value. If a building is in need of repairs and the current owners are planning on continuing to operate their business for years to come, a sale-leaseback could be structured wherein the buyer purchases the real estate asset for a discounted price with the requirement that the buyer applies the discounted portion of the purchase price toward upgrades and improvements to the property, such as modernizing the lobby or updating the restrooms. Through this type of transaction, the sellers cash out and also get a renovated building to work in, possibly throughout the remainder of their careers. As with any real estate decision, including a sale-leaseback transaction where the transactions are fact-dependent and can present advantages and disadvantages to the seller or buyer depending on the specific situation, you should consult an accounting, tax, legal, or other competent professional. You can find this and other helpful resources by visiting us online. Thanks for watching.